Good afternoon. Welcome to today's Savant live webinar. My name is Steve Lorence, and I'm a wealth advisor here at Savant. Today's topic, we will be talking about dreaming of retiring early. This is a really exciting topic for me to be presenting, regardless of whether you plan on retiring early or if you plan on retiring at normal retirement age. I hope there's going to be some things today that everyone can glean from this, really help them better prepare. With me today, I have fellow advisor Cory Barel joining me.
Hey, Steve. Yeah, thank you. Happy to be here today and excited about this topic.
Well, we're really excited about today, so we're just going to jump right in. Here's a quick agenda for you, just all the different things we're going to be talking about. Give you a second to look at that, but we'll move right over. We're going to start with looking at assessing your current financial situation. Regardless of when you're planning on retiring or depending on what your goals are, it's always good to assess where you're at today, so you know if you need to make changes depending on your goals or whether your goals change in the future. Some of the things you want to take a look at, we like to show this chart here. We have your ideal future. So what is your goal being in the middle? And you'll see at the top, we start with visioning and goals. Today, we'll be talking mainly about the retirement planning piece. Really, all these different areas flow into that retirement planning piece. We'll talk about risk management or the insurance side of things a little bit. We'll talk about debt and what makes sense or what debt you may have going into retirement, especially early retirement. If you plan on retiring early, you may have education goals still for your dependents or your children. Income tax is always going to be a consideration. We'll talk briefly about the investment planning side of things and some of those considerations, as well as estate planning, charitable planning. All those things come into the total financial planning package and planning for retirement. First, you're really going to want to take a look at your investment assets. You're going to want to review the assets that you have, determine where you're at, what you have. A good second step is if you have accounts all over the place. Sometimes you'll retire or you'll quit a job, you'll move jobs, and you'll have different 401ks outside. You'll have 3 different old 401ks. You may have an IRA at XYZ. And we encourage people to consolidate those. It makes it easier to assess what you currently have. You don't have to keep remembering where everything's at. And it also gives you a whole picture and just really makes things more simple for you. You want to look at what type of accounts do you have? Do you have traditional IRAs? Do you have Roth IRAs? Do you have just normal brokerage accounts, savings accounts? What does that look like? Do you have the right type of accounts knowing that you want to retire early? Beyond that, you're really going to want to look at your allocation. So what is your mixture of stocks to bonds? If you're planning on retiring early, in all likelihood, if you're 10 to 15 years out, you're going to want to be really aggressive in order to maximize the return you're having. As you get closer, especially in an early retirement, you're going to want to scale back that risk. One of the big risks for early retirees is that the markets go down significantly in the early days of your retirement. So you want to make sure that you have the right allocation in order to combat that. Housing, that's going to be another big factor, right? So carrying debt, as I mentioned earlier, there's certain debts that are good and bad. Housing or mortgage is usually people's biggest source of debt. If you're retiring early, you're going to need to come up with a plan for that. Do you want to pay down your debt ahead of time and use the hard-earned assets that you have? Or do you have a really low interest rate and it makes sense to continue that debt on even into retirement? You may want to consider downsizing your house. If your house is going to consume a lot of your budget, right? If you have a big house, bigger than you need, you have real estate taxes, those aren't going to go away. You have maintenance, utilities, those type of things on a bigger house are going to be expensive and could eat up a significant portion of your budget. Do you need to do repairs? Are there renovations that you want to do pre-retirement? Is there HELOCs that you want to take out on your house in order to give flexibility in the case that you may need it in the future? Those are all going to be major considerations as it pertains to housing, especially in an early retirement situation. You're going to want to take a look at where you're at from an expense side of things. So you're going to want to determine, do I need more income than I currently have in retirement? If that's the case, it's going to be a tough task in order to retire early. But you may, or hopefully you'll need less than 100% of your current income. So you may need more than 100% if you're planning on buying a second home, if you're going to be paying rent or a long-term rental in an early retirement. Are you still supporting dependents? If you're in your early 50s when you decide to retire, you may have children who are still of dependent age and still relying on you for their care and a lot of their expenses. That's going to be a big impact on your plan. What do your favorite activities look like? Some people have favorite activities like biking or running, and that they don't really cost a lot of money in order to do. Other people plan on spending their retirement traveling the world, and that's going to be quite expensive, especially when you have all the time to do it. You may require additional medical care, and that may be foreseen or unforeseen, right? So you may have an existing condition today that you know will likely cause you to have higher medical expenses later. Otherwise, it may be an unexpected medical expense, but you still want to plan for some of those unknowns that you think may have a high likelihood of happening. And then, are you supporting elder family members? You know, it's pretty common to hear the word sandwich generation, right? So in this situation, you're not only taking care of your children, you're also taking care of your parents. So you're going to want to plan for that. The more ideal situation, right, is needing less than 100% of your current income. So paying off your mortgage, that may help with that. And the big factor here is also going to be those dependents again. How are you going to plan for that? Now over to Cory for setting retirement goals.
Yeah, thanks, Steve. So once we've assessed where you're at today, the next big question is, what are my goals in retirement? This next slide here, you'll notice it's mostly blank, and that was partially on purpose, because if we were to list out all the different options you have here in terms of goals in retirement, we could fill 10 slides up easily. The essential question when you're looking at retirement is, what does this look like for me? And the answer there can range anywhere from, intensive international travel, building an antique car collection, all the way to homesteading and being self-sufficient and going off the grid. And, with that comes, a variety of different financial plans to support your goals. So determining what your goals and vision are of retirement is a big piece to determining whether or not your plan can support it. Oftentimes early in the retirement process with clients, and I'm sure Steve can confirm this, when we have that first conversation about, one of the key questions is, what are you spending annually? And clients will, typically say, this is my mortgage, this is how much I typically pay in my monthly credit card bills. So annually, I think it'll be X amount. And then you ask them the question of, well, what are your goals in retirement, and how do you think that will change your spending? And what follows this most typically is crickets for a few seconds. And then, I hadn't really thought about that. So having that conversation, or even, whether it's with your spouse or with your financial advisor, talking about that early in the process is key, because it dictates essentially whether or not your plan can support it. And it also dictates, saving now to making sure you can achieve those goals. So we have two fantastic resources that we use oftentimes with clients. I don't mean to ruin the next two slides, but they're essentially resources that we use with clients where, we're running through short, intermediate, and long-term goals. And, you don't necessarily need this to write this down. You can do it on a yellow pad, but kind of determining these and breaking them out is one of the huge first steps in the process. The following slide shows our retirement planning workbook, which is a similar concept, but just goes into a little more detail on information that we would like to gather if we're starting the retirement process. So, we're looking at Social Security. Do you have a pension? What are the value of all your investment assets? Do you plan to do part-time work? And what does the cost and timing of your goals look like? So all of these are important things to consider. And whether you, build out some sort of sophisticated way to track that on your own, or come to your advisor, I think it's a fantastic place to start, and will dictate, what you need to save or whether or not you're ready.
Yeah, and this is a really crucial component that a lot of people, I feel like, don't think about. To Cory's point, is you really need to know where you're going and what your time is going to look like, and what you're going to be spending your time to really accurately determine what your expenses will be. But also to determine whether you need to make corrections, or you may need to change direction from where you're at today, right? You think about a road trip, you need to know where you're going in order to know what course you need to take. So determine that goal, assess your current situation, and then either determine yourself or work with an advisor to determine what path or what steps you need to take today in order to accomplish those goals that you set for yourself. Next step, we really want to identify your early retirement savings strategy. So most of us are working, we're contributing to an employer sponsor plan, a 401k, 403b, maybe we're contributing to IRAs. But if you're retiring early, there's some things you need to consider. You need to consider some ages, and we'll touch on those, so I won't get too deep into that. Just highlighting some of the areas that you're going to want to look at as far as your investment and potential income buckets, right? So as I mentioned, those 401ks, those employer-sponsored plans. You may be a small business owner and have a SEP or a simple IRA. You may be contributing to a traditional IRA, or you may have traditional IRAs from your old employer plans. You may also have some fixed income sources. Most of us are going to have Social Security. Some of us will have pensions. You may also have annuities as part of your plan. This middle bucket, and I'll spend some more time talking about that, but this taxable brokerage bucket. So just think of a traditional individual account or joint account that you have. This is money that you've already paid taxes on and you're growing it tax-free. This is going to be the crucial bucket that you need to have if you're going to be retiring pre-55 in particular. The reason being is that there's no rules or stipulations as far as withdrawals from these accounts. If you look at 401ks, they have age restrictions. We'll touch on that. IRAs, they have age restrictions. So you really want to build up this taxable brokerage bucket. Health savings account, that's going to be another crucial bucket to potentially have. If you're on a high deductible savings plan or high deductible healthcare plan that allows you to save to an HSA, we really encourage people to take advantage of that. You get a tax deduction today, and you get tax-free distributions if they're used for qualified healthcare expenses. So this account is essentially double tax-free if they're used for the right type of expenses. Then you have those Roth 401k, Roth IRA. You may potentially have those. That's going to be money that you paid taxes on already. And in the future, all contributions and earnings are going to be tax-free. So it's really important to make sure you have the right mix of accounts here in order to accomplish those goals. Here's what I was talking about. There's some rules and stipulations of where can I draw from. So if you're under 55, your really two major options are going to be a taxable brokerage account or your Roth contributions. If you have 401ks, you have IRAs, Roth, there's going to be a 10% penalty for early distributions. On 401ks, if you're separated from service, you could start taking penalty-free distributions at 55. For those IRAs, Roth IRAs, 59.5 is that magic age where you lose that penalty. So if you're retiring at 50, there's potentially 5 or even up to 9.5 years that you're going to have to bridge with your taxable brokerage account or those Roth contributions or just cash that you have saved up in order to not pay those penalties. You need to think about it. If you have those penalties that you're paying, you're going to have to save potentially 10+% more in order to end up in the same spot. So that's why it's really important on that previous slide to pay attention to what buckets you have and understand when you're retiring and what that means from your withdrawal strategy. I want to put this up here, just showing what retirement plan savings limits are. So if you're under 50, you're going to be subject to $22,500. If you're over 50, you're going to have that additional $7,500 as a catch-up contribution for a total of $30,000 that you're able to contribute. I want to highlight this because if you're doing planning and you're determining that you need to save $30,000 a year for retirement in order to retire early, you're probably not going to want all of these savings to go into your 401k plan, right? You want to assess what buckets you want to save to or how much you want to save into each bucket as it pertains to your overall savings picture. If you're just saving towards a retirement plan, as I described in the last slide, you may end up in a situation where your retirement plan rich and cash or brokerage or taxable bucket poor. And that doesn't put you in the best situation if you're going to be an early retiree or if that's a goal of yours. So it's something you want to consider and take a look at. You're going to want to look at budgeting and saving. This is really, really important. Certainly you want to have an inventory of your assets and net worth statement, but I'd make the argument that tracking your monthly spending may be even more important. And I think you want to really be honest with yourself, in particular, if you're retiring early. This is going to be if not the largest factor as it pertains to what planning you need to do now and whether your plan is going to be successful. You want to avoid immediate pain. So how do you start saving more, right? One way is just slowly increasing 401k contributions. But as I mentioned, that's not going to give you the whole picture. You want to look at what bucket you're saving to. You really want to start out with a goal of saving at least 10%. I would say you really want to look at trying to save 20+% of your gross income if you're planning on retiring early. If you're 30 and want to retire at 50, I would say, probably 25% is going to be better for you. What I would recommend is saving as much as you can as early as you can. I've never met somebody who's been upset about how much they've saved by saving too much too early. If anything, it will at least provide you with more flexibility. It may give you the option to retire early and you weren't planning on it. I'd rather have the option to retire early and not take it than want to retire early and not have that option, right? So we want to make sure that we're planning for that. Again, you want to build up that non-retirement liquid savings. So you're going to have the cash reserves. This says 3 to 6 months, and that's a good amount to have if you're still working. But if you're retired, in particular, an early retiree, you're probably going to want to have closer to 6 or 12 or 6, 12, 18, 24 months worth of expenses. Everyone's got a different number that they're comfortable with. But beyond that, you're going to want to have a bigger brokerage bucket. That may have 3 to 5 years worth of cash. If you're planning on retiring at 50, that may need to have 10 years worth of cash flow in it in order to accomplish your goals. So it's really important to track your monthly spending so you can get an accurate estimate as how much you need to be saving in order to accomplish those goals.
Perfect. Yeah. So Steve just talked a lot about the different buckets and where we should be saving to as we're approaching retirement. But then the flip side of that is once we're in retirement or in the early years of it, where do we want to draw from? So I just want to touch on the most common sources of income in retirement. Steve already touched on a decent number of these, but we're going to start at personal savings. And in here, I'm going to include any cash that you have in the bank, as well as taxable brokerage accounts, potentially Roth or traditional IRAs as well. Then we have Social Security. So that'll start somewhere between the ages of 62 and 70. Employer-sponsored retirement plans covers 401ks, 403bs, and the other qualified accounts you're saving to through your company. Part-time work is a major one for early retirees, especially if you're looking at it in your early 50s. A lot of people will kind of wean themselves off work to an extent. It also, the early years can be difficult when you first switch off of spending your income that comes in, biweekly or monthly, and start drawing down that bucket you've been saving into for 30 years. So part-time work can help a lot with that transition. Rental income is another common one we see. Either you own an investment property that you rent out, or sometimes clients will purchase a second home and rent out the initial one and kind of split the year between the two. So that's another pretty common source that we see. And lastly, pension plans. So if your company has a pension plan, this can be a great source of income. And as we'll see on this next slide here, one of the first places we want to draw from. So if we're talking about an order, it's difficult to give a precise order, but we have some good guidelines here. So notice in the center of the circle, that green, we're going to want to start with non-market dependent sources. And by that, we mean, they're not invested in the market and they're coming to you on a frequent basis. So in this case, it would be Social Security, pension, or potentially an annuity if you have one. The next one we're going to want to move to is required minimum distributions. So I'm going to assume on this, if you're on this call or this webinar, you're probably under the age of 72. The rules recently changed where required minimum distributions are now 73 and will be pushed back, to 75 by 2033. So they're pushing that age out a little bit. It might not be applicable to your first few years of retirement, but still definitely something to keep in mind. You'll have to take out a portion of your qualified accounts every year as a required distribution. And the last place we're looking is supplementary. And I don't know if I love that titling, because for most people, it's going to be the main source of income in retirement. It's going to be your market dependent sources, AKA your investment assets. So these are your IRAs and 401ks, your Roth IRAs, non-qualified investments, which just mean that taxable brokerage bucket that Steve was talking about, and your bank savings. The order in which you draw from these market dependent sources typically varies by the amount that you have in each bucket. I mean, if you have huge taxable accounts, that's probably one of the first places that you'll start drawing from. If you're mostly qualified money and over the age of 59 and a half, you might want to draw that down more early in retirement, so your RMDs are smaller later. All considerations that are slightly dependent on your situation, but following this general outline is a good place to start. Other considerations. So, a question that we get pretty frequently is, how much can I take out? Is there a rule of thumb I can use there in terms of, percentage of how much I'm worth or how much my investment assets are worth? And the conventional wisdom here is somewhere between 3 and 5% of your total invested assets. So that includes retirement accounts, taxable accounts, et cetera. Generally, we would lean more towards 3% when you're early in retirement, because you have, this 40+ year time horizon you want to make it last over. As you get later into retirement, that time horizon shrinks. You can start going a little bit higher, 5%, 6%. If you're 90 and you still have a good amount of money left, you can probably be drawing 10. So the percentage varies, but staying between 3 to 5%, especially in early retirement, is a great rule of thumb to follow. Just to briefly explain where that's coming from, if you assume that a moderately risky portfolio returns about 7% per year, if you're taking out 4, that leaves 3% to combat inflation. So you're maintaining the value of those investments going forward and not drawing it down relative to inflation. So good rule of thumb, good place to be. Other considerations, we want to make sure your risk tolerance and allocation are aligned with your plan. By that we mean, if you're in your 30s and looking at retirement, you want to give those assets space and time to grow at potentially a more aggressive allocation. And as you approach retirement, we often see people reducing that down. So just making sure that your allocation is aligned with your financial plan is a key part. So kind of to end, the goal is to identify how much you can take out without depleting your investment assets. Lastly, we just briefly wanted to touch on Social Security. It's not going to be applicable in your 50s, but it is still going to be a piece of your retirement picture. And there's a lot of confusion surrounding the rules here. So Social Security, you can claim between the ages of 62 and 70. If you delay, your benefit will be slightly increased. So when you receive a Social Security statement, the stated amount on there is going to be your full retirement age benefit, which for most of you is going to be age 67. Every year that you delay past that, it increases by 8% until age 70. And if you take it before that, it will reduce it by a similar percentage. So taking it early can be a good strategy if you don't have a huge investment portfolio, and you would be drawing it down significantly if you don't file for Social Security. Taking it later will be a good strategy if you have a family history of living into your 90s, and if you have sufficient investments to cover your expenses until you file. Factors to consider here, I just mentioned the health and life expectancy. Another piece is if you do part-time work, your earnings can actually reduce Social Security if you go over a certain threshold. Spousal benefits, so you might be eligible for your spouses or vice versa. Ex-spouse is a similar situation. And then lastly, survivor benefits.
Awesome. Thank you, Cory. I'm going to cover healthcare costs really quickly. As I mentioned earlier with the HSA, healthcare could be a big portion of your expenses. You think about while you're working, you're likely not paying for 100% of your healthcare. Likely there's some sort of split. If you work at an employer, you may cover 50%, they may cover 50%. And that could be a really large number for folks. In particular, if you have dependents on your plan still in retirement for an early retiree, this could be a really huge cost. So it's something you definitely want to plan for. I always tell people healthcare shouldn't be a reason to not retire if you can afford to do so, but it's a big expense and you do want to take it in consideration. And you also want to plan for the fact that there may be an unexpected expense, especially as we get older. Even if you're 50s and 60s, the likelihood that you have a bigger healthcare expense is far greater than when you're in your 30s, right? So you want to plan for that. You want to plan for the unexpected knowns that are likely going to happen, right? We don't know when a healthcare event is going to happen, but if we live long enough, the likelihood that one's going to happen that we should plan for increases, right? So we really want to pay attention to that. Looking at healthcare costs, so COBRA is going to be that continuation insurance. If you leave your job, you retire, you have 18 months that you could stay on COBRA. Often that could be $400, $700 per month per person. It could be $5,000 to $12,000 more than what you're used to paying on your own. So that's going to be a really important consideration. The maximum amount that they could charge you is 100% of that group plan, plus a 2% fee. So 102% is what is going to be the maximum amount that you're paying in premiums. You have private marketplace insurance. That could be up to $655 per month per person at the age of 50. So you're looking at $1,300 per month in between spouses if you're on private marketplace insurance. If you're 60 or above, you're looking at almost $1,000. We've seen it more than $1,000 per person per month. So you could be looking at $24,000 a year in healthcare expenses. And that's just in premiums. That does not include out-of-pocket expenses. So you could have some really high healthcare costs. So you really want to plan for this. With the Affordable Care Act, there is a healthcare exchange that does offer subsidies depending on your income level. If that's something you want to speak with a healthcare professional, speak with an advisor, and see if there's a way that in your plan that you're able to qualify for some of those subsidies to potentially reduce your healthcare costs. Another thing you're going to want to consider, and it may be far off in the distance, right, if you're thinking about retiring at 50, but the likelihood that some of us are going to need long-term care at some point is increasing, right? Insurance product, long-term care insurance is an insurance product that helps pay for the costs associated with long-term care. So think about if you're in a facility, it covers expenses that Medicare or Medicaid does not. The one downside to a long-term care policy is that they are incredibly expensive. You're probably going to want to have some portion of self-insurance, even if you have a long-term care policy. There's elimination periods, so they don't kick in right away, typically, maybe 30, 60, 90, 120 days. In order to qualify, you're going to need to not be able to perform 2 of the 6 following activities, right? So the 6 activities of daily living, so dressing, bathing, eating, toileting, continence, and mobility. Those are all things that come into play. And you want to make sure that you really understand your policy. You want to understand, one, the benefits, but you also want to understand when they kick in. As I mentioned, self-funding for long-term care, that's going to be how most people need to handle it, whether because they can't afford the premiums or otherwise they're buying a partial long-term care policy, meaning they're trying to insure part of the risk. If you look at pure self-funding, or if you're looking at just pure cost of what a long-term event could be, it's not uncommon to see them exceed $100,000 per year. So that's something you're really going to need to plan for. Now, that's on the high end, right? We see instances of $60,000, $75,000 a year, but the point being, these could be really, really high cost. So if you're self-funding this, you're going to really want to plan for this. If you have the ability to self-fund part of it, it provides additional flexibility and liquidity. So a traditional policy is going to pay you on a monthly basis, typically. Oftentimes it's reimbursable. But you're going to need to have liquidity to be able to pay for these expenses until your policy can come in and step in for that. And you must be prepared to deplete resources substantially in the case of a long-term care event if you're planning on self-funding. So this is a major consideration, in particular, if you're looking at retiring early. If you retire early, you may be drawing down your assets. So you may not have as much to cover a long-term care event. So that may make it even more important to look at long-term care insurance as an option.
Yeah, so we've reached the last section here. So we're going to talk about some early retirement risks. And we just wanted to open up here looking at some of the spending categories in terms of short, midterm, and long-term. Early in retirement, it's particularly important to have a good handle on your spending. So we have the short term, which are also viewed as necessities. So your mortgage, your groceries, your utilities, your typical monthly bills that come in that are under your control to an extent, but are generally going to come in month by month regardless. Your midterm goals are ones that you also have a good amount of control over. So we're talking about education, potentially for dependents. If you're retiring at 50, you might have kids that either still live in the house or who you're funding college for. So planning for that is key. Home, a couple different sections within this. If we're talking about home maintenance, home improvements, or potentially purchasing a second home. All of these are items, midterm that you definitely want to have factored into your plan. Vacations, you can choose to do a very luxurious vacation. You can choose to tone it down a little bit. If you're retiring at early 50, there's some trade-offs that you might have to take a look at in planning for that. And lastly, care. Steve just touched on this in some detail, but healthcare and long-term care can be large expenses in retirement. And lastly, we have retirement as the long-term goal. And within that, we have all those different options we talked about earlier. I mean, every plan varies a huge amount. It says a 25-year vacation here. If you're retiring in your 50s, the time horizon for that is probably 40. So you need to plan your goals to last those 40 years in retirement. So key component. This next slide shows a lot of the most common risks or worries of early retirees. So looking at the sustainable withdrawal rate, looking at potential solvency for your pension plan or Social Security, making sure, looking at savings, making sure you've saved enough leading into retirement. Longevity. So interesting fact here, a couple age 65 has a 25% chance of one of them living to age 96. So if you retire at 50, that's 46 years that you need to make that investment portfolio and those retirement income streams last. Inflation, that's been a big topic in the last 2 years, as has market volatility. I mean, we peaked at over 9% last year. It's down to 6 now, but it's been a big piece. It erodes the value of the earnings in your portfolio and also reduces the base value. Retiree spending, this is the one you arguably have the most control over. We're going to talk a little bit, later about having flexibility in your plan, but it's a key piece. So looking at all of these, it can be a little bit scary, but the idea here is with a comprehensive financial plan, you can combat all of these and go into retirement feeling confident. So withdrawal rate, if you know your portfolio, if your income that you need from your portfolio, if you know that's somewhere in the 3 to 5% range, you're going to feel a lot more comfortable about that. If you have confidence in your pension plan, if you've done some research and seen the different options, or looked into your own finances and said, even if this fails, I'm still going to be okay. Market volatility, you can combat this by having an allocation and an investment plan that matches your time horizon and you feel confident in, and then market volatility won't impact you as much. So essentially all of these can be combated if you're feeling confident in your plan and you really look at it prior to making that leap into retirement. Steve also touched on this pretty early in this presentation, but reducing debt is especially important for a lot of early retirees. I mean, I think the fact on the first slide was it's one of the most significant stressors, and that's very true from clients that we work with. Debt is a consistent payment that you have to make, so it provides overhead essentially that you can't be flexible with. So reducing debt, particularly your most high interest debt, is a key part, and these are some useful steps you could follow.
Yeah, this is really important on that previous slide. The more debt you reduce, there is some good debt, there is some bad debt. But essentially going into an early retirement in particular, the less overhead as Cory just mentioned, you have, the less risk that you have to your plan, right? All of those risks that we just touched on can be mitigated. They're always going to exist, but the less you have to spend, not the less you do spend, but the less you have to spend in order to live your life, the less those risks come into play.
Yep. And the last key piece, as with any financial plan, whether you're retiring earlier or retiring, at a more typical age in the 60s, is regularly reassess your situation. And another way to view this is, the best way to retire is by being flexible with your spending. We have a lot of retirees saying, okay, I'm drawing 5%, so I'm right on that border. What happens if the market takes a huge downturn? And the realistic answer is your plan will probably be fine. You might just need to make some adjustments there. So being flexible is a key, specifically early, because you don't want to draw down those assets. So it's just something we wanted to impart. And last thing, a good rule of thumb is a 5-year buffer to cover any unexpected situations. A good example here is, if you have a 5-year buffer in terms of cash or more conservative investments, and the market takes a huge downturn, think, knock on wood, but an 07, 08 situation. The 5-year buffer will allow you to draw from a piece of your portfolio that probably did not take as large of a hit and allow the other assets to recover their value. So particularly if you're nervous about retiring, this can be a great thing. Everyone ranges a little bit on how big their safety net is. I mean, we have people who are confident in the market, riding it out, and who only have 6 months of cash on hand, up to people who have half their portfolios in it. So a 5-year buffer is a good rule of thumb, but it's also something you'll want to talk to your advisor about and determine what works for you.
Absolutely. And really the big thing here is just continue to maintain that flexibility, as Cory said, right? Maintain the flexibility, keep an open mind as far as what your spending looks like, the timing of certain spending. If the markets are down early in retirement, maybe you do push back that 3-month European trip. Maybe you do plan on going back to work part-time, but maintain that flexibility, keep an open mind, but really just continue to reassess that situation and be able to change depending on how your goals change, depending on how your life change. This is the end of our prepared content for you. We really do appreciate you coming on the call today. And thank you again for joining Savant's live webinars.
Yep. Thank you all.